Hi everyone. This Excel workbook focuses on the indirect method for preparing the statement of cash flows. In Chapter 16, we're going to focus on the indirect method. Oddly enough, FASB prefers the direct method. However, 97% of all U.S. companies use the indirect method. The reason for this we'll discuss later, but it's easier to use the indirect method than it is the direct method. The problem with the indirect method is in the operating section of the cash flow statement. There are a few items that need to be adjusted. The indirect method begins with net income and then adjusts the total net income to reflect cash flow. Probably the easiest of these adjustments to understand is depreciation, which is in tab 2. For example, suppose we have depreciation expense of 1,000. Well, as you should know, depreciation is not a cash flow. So when you look at the effect of the cash balance, there is no effect. The debit is to depreciation expense, the credit is to accumulated depreciation. The only effect is that net income is reduced by $1,000. Now let's look at the bottom of this tab. What's happened is that $1,000 has made net income smaller. And so what we have to do is add back the depreciation amount to make net income equal cash flow once again. In other words, in this case, net income is minus 1,000, cash flow is 0. So by adding 1,000 to minus 1,000, we get back to the 0 cash flow. If you look at the balance sheet, once this transaction happens, both assets and liabilities, actually equity, are reduced by $1,000. You notice on the operating section of the statement of cash flows, we have net income at the top. Just since we're just considering this one transaction, net income is minus 1,000. We add back the depreciation of 1,000 and we get 0, which is the correct cash flow from operations. Now the cash flow statement is correct. So the first rule is to add depreciation to net income, whatever that depreciation amount turns out to be. Now let's look at current assets. Common current asset is accounts receivable. If we have a sale on account, the two accounts affected are accounts receivable and sales revenue. It's a debit to accounts receivable and a credit to sales revenue. Notice cash, again, is not affected. Because of the sales revenue, net income's increased by $1,500. So that sales revenue wasn't associated with a cash inflow. Let's look at the diagram again. Here net income is too high relative to cash flow. Therefore, by subtracting out the increase in accounts receivable, we turn net income back into net cash flow. In this case, on the balance sheet, assets and liabilities and equity have gone up by $1,500. On the cash flow statement, we have net income of 15. We subtract the increase in the current asset, in this case depreciation, and we get 0 once again, which is the true cash flow from operations. So the second rule is to subtract all increases in current assets, whatever they may be. Notice what happens when the accounts receivable is paid off. In this case, we get cash of $1,500 and the accounts receivable balance is reduced. So there's actually no change in assets, and no change in equity. Notice up at the top, net income is not affected. Here, what's happened? Cash flow has increased, and so therefore we must add the decrease in current assets, in this case accounts receivable, to make net income and cash flow equal. On the cash flow statement, net income is 0, cash flow is a positive 1500. That positive 1500 came from those accounts receivable being paid off. So we have to add the decrease in current assets to get our true cash flow from operations. So we subtract increases in current assets, but we add decreases in any current asset to our net income, because any increase in those asset accounts is going to make net income and cash flow deviate from one another. All right, now let's look at current liabilities. In this case, we're recognizing that we owe employees $2,000 in salaries. The debit is to salary expense. The credit is to salaries payable. Notice no cash has transpired. On the balance sheet, equity has declined because of the expense. Current liabilities have gone up because of the payable, and there's no effect on assets, liabilities, and equity. Down below, net income has gone down and cash flow has stayed the same. So what we have to do is add the $2,000 increase in the salary payable, in this case a current liability, to make net income equal to cash flow. If you look at the statement of cash flows, we start out with a minus 2,000 net income. That's a non-cash expense. And then we add back the $2,000 in current liabilities, and that gives us our correct cash flow of 0. So if we go back to our chart, we should add increases in current liabilities to net income. Now let's say we pay the salaries that we recognized before. Well, in this case, there's no effect on net income because the expense happened previously. However, we do pay $2,000 in cash. On the balance sheet, both current liabilities, the salary payable, and cash goes down by $2,000. So cash has declined and net income hasn't changed. Therefore, we have to recognize that it cost us money to pay off that payable. So we have to subtract the $2,000 decrease in the salary payable from net income. Again, net income is 0. We subtract the 2,000 and we get our true cash flow of minus $2,000. So this rule, subtract decreases in current liabilities from net income. The next two are perhaps a little bit more complicated. Let's take a look at what would happen if we sell a piece of equipment with a net book value of 40 for $45,000. In this case, what's going to happen? We have to eliminate the net book value of the equipment. That involves getting rid of both the equipment account and the accumulated depreciation. We're going to get $45,000 in cash. However, the equipment's only worth $40,000. So we're going to have to recognize a gain of $5,000. That gain affects net income. Okay? On the balance sheet, what's happened? Cash has gone up by 45. Equipment, the net book value has gone down by 40. So total assets have gone up by 5. Equity has also gone up by 5 because of the gain. Net income has gone up by 5, but as you will see, it should not have from a cash flow standpoint. On the cash flow statement, what we do is we put the entire $45,000 cash in the investing section. It doesn't even go in the operating section. Because of this, if we left the operating section alone, the total cash flow would be $5,000 from the net income plus 45 from the investment account, and that's $50,000. But we know that the total cash we received was actually 45. So what we have to do is back this gain out of operations so that we're left with the true cash flow of $5,000. Backing out the gain involves subtracting whatever that gain is in the operating section. Again, the philosophy is we put all of the proceeds from sale of investment in the investing section, and we back out gains or losses out of the operating section. To illustrate a loss, what happens if we sell the same piece of equipment for $32,000? Well, notice what happens on the balance sheet. Equipment's gone down by 4, but cash has only gone up by 32. So assets have declined by 8. This is shown in the income statement as a loss. However, net income has dropped. From a cash flow standpoint, we have to back that loss out of net income. And here's why. On the cash flow statement, the cash from investment is $32,000. That's the correct amount of the cash flow. Net income, however, is showing a minus $8,000 loss. If we left that in, the cash flow for investment would be $32,000 minus 8, or $24,000. That's incorrect. So we have to back this loss out of net income to get the true cash flow from operations, which is 0. And now all of the cash is in the correct place in the investment account, and we have the correct balance in the investment account. So I hope this video has helped to explain this spreadsheet. Just remember, using the indirect method, you always start with net income, you add depreciation, you subtract any increase in current assets, you add any decreases in current assets, you add increases in current liabilities, you subtract decreases in current liabilities, and you back out gains or losses. That, in a nutshell, is the indirect method of the statement of cash flows.